Taxes are easily the most hot button issue for us Americans. Heck, we went to war over it. And when it comes to investing, the government certainly doesn't make it easy to understand how taxes work. You have multiple tax brackets, different tax tables, right? And gains and losses are all treated differently. And different investment types and accounts get special or not special tax treatment. It can make your head spin. So today we're going to try and break one part of that tax system down that's especially confusing: capital gains. We're going to answer the question of what they are, how they work, and other tax tables, and whether or not they can push you into the next tax bracket. Hi, my name is Chris Cebulski, and I help people like you retire with dignity, purpose, and your eyes set on the future. So first, there are two tax tables for individuals in the US: the federal tax system, which has 7 brackets, and the capital gains table, which has 3 brackets. So the federal brackets are for things like your W-2 employment income, salaries, pensions, IRA withdrawals, Social Security if it's taxable, rental income, business income, all that good stuff. So that income is taxed at ordinary income tax rates, which is this chart here. So it's taxed at a marginal rate as well, meaning that each sort of portion of your income is taxed at a different rate. Think of it like a reverse waterfall, filling up cups. The water can't fill the next cup until the bottom cup is filled. So let's imagine a couple earning 200K of income, puts them right at the top of the 22% tax bracket, but they don't pay 22% tax on all of their money. So here on the chart, we see they pay a portion of the money at the 10% bracket, then a chunk at the 12%, and then the 22% almost completely fills up. Now, in other countries, you pay based on the last bracket you're in, but not here in the US. We pay into each bracket as they fill up. Now, the second table I'm going to show you here is the capital gains bracket. There are 3 brackets instead of 7. And also the brackets are more favorable: 0%, 15, and 20. So you pay based on your ordinary income and capital gains income. So a lot of people obviously are probably looking at the 0% rate here, which is, if you've seen any of my videos in the past on how to pay 0% in taxes early, you're probably looking at that and going, how do we do this? Well, basically, this is saying if you're a married couple and you can have up to $96,700 of taxable income and pay 0% on long-term capital gains. So how do these two systems interact with each other? And, say if I go over this bracket by $1, does that mean that all of my capital gains are taxed at 15% in the higher bracket, or just the next dollar that's over the threshold? So that's what we're going to go and look at today. And let's look at a couple examples. But before we do that, I just want to look at it another way. And here's a way to visualize it, of the two tax systems and how they work together. So on this page, you have the married filing jointly tax brackets here in the middle. It's going to be those ordinary income tax rates. And then in the green, it's going to be the long-term capital tax rates. And the same for single filers over here on the right. So basically, depending on your income, and again, these lines are going to represent the top of the tax bracket. So 10% tax bracket applies to income under $23,850. That would mean that you're still at the 0% tax bracket for long-term capital gains. As you can see here, the 12% tax bracket and the 0% tax bracket, they don't exactly line up. They're not the same, which is like, the most bureaucratic thing ever, right? But basically, this is a good way to visualize what capital gains tax rate applies to you based on, again, your taxable income, which is in this left column here. Now, what we'll look at in the examples in just a moment is that these two types of income are taxed separately. So although your income, both of them are ultimately combined, it's then split out among these different tax tables. So again, your salary would be taxed at these federal tax rates, and your long-term capital gains taxes would be taxed at the capital gains rate table, right? Now, something I've left off of here is the net investment tax. This is a tax of 3.8% added to investment income if you make over a certain amount. Let's just ignore that for this moment. It's there. Let's just ignore it though. So in our first example here, we're going to look at a married couple who's retired. We're going to assume that they're over the age of 65 and they have $70,000 of ordinary income from rentals or some business income or Social Security, something like that. And let's assume that they sold some stock in a taxable account and have $50,000 of long-term capital gains. So how does this affect their overall tax rate? So in scenario one, we have their wages at $70,000 here, and then we have their long-term capital gains at $50K, bringing their total income to $120,000. As far as their deductions go, we're going to assume that they take the standard deduction, which for a married couple over the age of 65 is a total of $34,700. Again, that's comprised of $31,500 for the standard deduction for a married couple, and then for each spouse over the age of 65, they get an extra $1,600. So in addition to the standard deduction, they'll also get the senior bonus deduction, which is new under that One Big Beautiful Bill Act, and that's $6,000 per taxpayer over the age of 65, meaning $12,000 in deductions total. So after deductions, essentially that brings our taxable income to $73,300. And again, that's the number that we're going to look at to see what and how capital gains rates work and what brackets they fall into. So using that same chart that we looked at a moment ago, we can visualize how this different income is taxed and whether or not those capital gains do bump you up into a higher bracket. Once again, here's the example one here. We have $70K in wages, $50K in capital gains. $46,700 is our total deductions. Amazing. And it's important to note as well that with your deductions are taken off of your ordinary income, not your capital gain income. So that's actually really beneficial because, your capital gains brackets are taxed more favorably than the federal brackets, right? So you want the deductions to be taken off the less favorable income, obviously. So their ordinary income after taxes is $23,300, which means that they would fall into the 10% tax bracket. Again, just for their ordinary income, just ordinary, right? And we did that by taking $70K in income minus the deductions. Got it? Now, here's where the capital gains come in. So the $50,000 in capital gains are stacked on top of your ordinary income. So the floor of your capital gains actually starts where the ordinary income ends, and it's added on top of that. That brings their total taxable income to $73,300 when you add that $50K on top of it, right? That means they're still within the 0% capital gains tax bracket. So they won't pay a single dollar on any capital gains taxes for that $50K. So going back to the main question of the video here, do long-term capital gains push me into a higher tax bracket? The answer to that is no. And once again, that's because your long-term capital gains are always going to sit on top of your ordinary income. Remember, there's two systems, capital gains and federal. Capital cannot move federal, but federal moves capital. It's like a rock. Rock will never beat paper, right? And rock, paper, scissors. Rock only beats scissors, right? Now let's revisit the same chart to see what that looks like here. So once again, to visualize this, we have our example number 2, this time with a $40,000 traditional IRA withdrawal. But this time after deductions, their ordinary income is now $63,300, which pushes us into the 12% tax bracket. So once again, they pay 12% on this amount. And then this also pushes their $50K in capital gains into the 15% tax bracket. Now, to answer the other question that we asked earlier in the video was, does this cause all of my capital gains to be now taxed at 15%? The answer to that is also no. So fortunately, capital gains are also taxed at a marginal rate or in the marginal system, just like ordinary income. So that means the majority of them are, in this scenario, will still be taxed at 0%. And only a couple thousand over will be pushed into that 15% tax bracket rather than the full 50,000 that they harvested. So as we saw today, capital gains do count toward your total taxable income as well as your adjusted gross income. Now, this is an important figure, and it's used for a lot of different things, from Social Security taxation to IRMA, your Medicare payments, which is, the surcharges you get. And then there's senior bonus deductions that we just saw a minute ago. But your Social Security is taxed based on your provisional income, which includes your adjusted gross income plus half your Social Security benefit income plus any non-taxable interest like, municipal bonds. And then your Medicare surcharges are also based on your modified adjusted gross income, which is your AGI plus any deductions that get added back. So when you're planning your withdrawals in retirement, think through these different brackets and tax tables to try to make the most of the opportunities to save on taxes. This is the easiest way to think about withdrawals that you take in retirement. We typically start with a traditional IRA first, as long as it doesn't, bump us up into another bracket. Then we use our taxable account to harvest gains and losses to stay in our current bracket, or to take advantage of, better capital gains rates. Maybe we're in that 0% bracket. And then finally, we tap our Roth IRAs when we need emergency money, or using the other accounts, might bump us up. So this is what financial planning is. This is what I do for my clients every day. Thinking about taxes and thinking about their tax rates can save you tens, if not hundreds of thousands of dollars over your retirement. Now, if you're watching this video and you think this is all too much to handle, or you want someone to help you, or maybe your own advisor isn't doing this type of work, I'd love to talk. Please drop a like. Please subscribe. Would love to hear from you. My email is in the description. I hope you have a great day.